Right now, something is happening in the markets that most people are completely ignoring, and the ones who ignore it today will regret it for the next 5 years. My name is Zara, and what I am about to share took me years of painful, expensive lessons to finally understand. So stay with me, because this is not just another stock video. This is a conversation about survival, preparation, and the kind of clarity that most investors never find until it is already too late. Let me take you back to a quiet Tuesday morning. The sun was out, my portfolio was showing green, and I remember thinking, this is it. My patience is finally paying off. And then, within 6 weeks, everything changed. Not just for me, for millions of investors who were sitting in that same comfortable chair, watching that same comfortable green. The market does not care how comfortable you are. When panic hits, it hits everything. Now here is what I want you to understand from the very beginning. Fear is not a strategy. Panic is not a plan. What I am here to give you is a framework. A way of thinking about markets and opportunity that will serve you not just today, but for the rest of your investing life. The title of this video says, Last Chance. I chose those words deliberately, not to create hype, but because in investing, genuine windows of opportunity open and close. And most people miss them not because they lack information, but because they lack preparation. When the window opens, they are standing outside with no plan and no conviction. Market panic is a predictable human response to uncertainty. People feel something is wrong. They cannot identify exactly what, so they act. They sell. And when enough people sell at the same time, prices fall. When prices fall, more people get scared. More people sell. It becomes a self-reinforcing spiral that feeds on itself until it exhausts itself. This has happened before. It will happen again. The only question is where you are positioned when it does. The most dangerous thing about panic is not the falling prices. It is what happens to your thinking. The conviction you had when you bought starts to crack. Fear rushes in, and fear turns into the worst decision an investor can make. Selling good assets at bad prices and then watching them recover without you. The investors who come out stronger on the other side are never the ones who predicted the panic perfectly. They are the ones who were already in the right positions before it started. They understood what they owned. They had a plan. And they had the emotional discipline to follow it when everything around them was screaming to do the opposite. The time to prepare is never during the storm. It is before it. And right now, the market is sending quiet signals, the kind that do not make headlines. Volatility is climbing in certain sectors. Credit markets are showing stress in pockets most retail investors never look at. And on the surface, everything still looks mostly fine. This is the calm before. In the parts that follow, we go deeper. The 4 stock categories, the logic behind them, the mistakes investors make when panic arrives, and the long-term strategy that separates those who build real wealth from those who stay stuck buying high and selling low forever. Before I name these 4 categories, I want to be clear about something. This is not a list of ticker symbols. I am not going to tell you what to buy tomorrow morning. What I am going to do is something far more valuable. I am going to give you the logic behind why certain types of companies hold up during market stress. Because the specific stock is almost secondary to the framework you use to evaluate it. Give 2 people the same stock idea, and one will hold it through a downturn with conviction, while the other panic sells at the bottom. The difference is not the stock. The difference is the understanding. So let us build that understanding together. The first category is what I call essential demand businesses. These are companies that sell things people genuinely cannot stop buying, regardless of economic conditions. Think about the last time you stopped buying groceries because the market had a bad week. It does not happen. And the companies that supply genuinely unavoidable goods and services carry an invisible protection during downturns that more glamorous businesses simply do not have. But within this category, what you are specifically looking for is pricing power. The ability to raise prices without losing customers, because the product is so essential that people absorb the increase rather than walk away. Companies with genuine pricing power can maintain and sometimes even grow their margins during economic contractions. That is the kind of business you want anchoring your portfolio before a period of uncertainty. The second category is the infrastructure of the digital age. And I want to be careful here, because when people hear technology stocks during a potential downturn, they immediately think destruction. And they are partially right. Speculative technology companies burning cash with no clear path to profit get hammered first and hardest during panic. But there is a completely different category within technology. Companies whose services are so embedded in the basic functioning of other businesses that switching away is practically impossible. The software running hospital systems, the cloud infrastructure banks depend on, the cybersecurity services organizations are contractually required to maintain. These businesses do not rely on consumer confidence. They rely on operational necessity. And operational necessity is a far more durable revenue foundation than consumer enthusiasm. What you are looking for here is revenue stickiness combined with long-term contracts. When revenues are locked in through multi-year agreements with large institutional customers, a quarter of market panic does not make those revenues disappear. The business keeps running. The cash keeps coming in. And while the stock price may dip with the broader market, the underlying business is not impaired. That disconnect between price and business reality is where long-term opportunity lives. The third category is healthcare. Not speculative biotech, one clinical trial away from losing everything overnight, but durable, established, diversified healthcare businesses. Hospital management, medical supply distribution, diagnostic services, the unglamorous, essential companies that healthcare systems worldwide depend on every single day. The simple truth is, people do not stop getting sick because the economy is struggling. Healthcare demand does not reverse based on quarterly GDP data. What you want here are companies with diversified revenue, strong balance sheets, consistent cash flow, and exposure to structural growth rather than cyclical growth. A structural business grows because of deep, long-term trends that unfold over years, regardless of what any single quarter looks like. The fourth category requires the most nuance: financial services. And before you close this video, hear me out, because this is not what you think. Yes, certain financial companies get destroyed in a crisis. The highly leveraged, the overly exposed to bad credit, the ones running on thin capital with aggressive risk. Those can be catastrophic. But within financial services, there are businesses that actually benefit from market stress. Asset managers who earn fees on transaction volume. Insurance companies with conservative portfolios and pricing power on premiums. Financial infrastructure companies that process payments and earn a small fee on every transaction moving through the global economy, regardless of whether markets are up or down. These businesses profit from the activity of the financial system, not the direction of it. That is a fundamentally different risk profile than most investors assume. Now, here's what ties all four categories together. Every single one generates real cash from paying customers. Every single one serves needs that do not disappear in a recession. and every single one has a durable competitive advantage that protects it even when economic conditions deteriorate. When you learn to evaluate stocks through these three lenses, real cash, recession-resistant demand, and durable advantage, you stop being attracted by what looks exciting and start being attracted by what is genuinely strong. That shift in perspective will protect you in the next panic and in every market challenge you face for the rest of your investing life. I want to start with an honest confession. Knowing the right stocks is only half the battle, maybe less than half, because I have watched people own exactly the right companies and still lose money. Not because the business has failed, but because they failed. Because their own behavior during the panic undid everything their research had set up correctly. The first and most costly mistake is conviction without preparation. This is when an investor buys a stock for the right reasons, but has never asked themselves the most important question before buying. What would I do if this stock dropped 30% in the next 3 months? Not because the business broke, just because the market panicked. If you have never answered that question before buying, then when it happens, you are making that decision under maximum emotional pressure, with zero prior thinking to guide you. And those decisions almost always lead to the same outcome. You sell. You lock in the loss. You wait for certainty. And you watch the recovery happen without you. The fix is simple. Before you buy anything, write down 3 things. Why you are buying it. What would have to change fundamentally for you to change your mind? And what price decline you are willing to tolerate before you reassess. Not react, reassess. Those 3 things become your anchor when the storm arrives. The second mistake is position sizing driven by excitement rather than risk management. An investor finds a compelling story, the numbers look good, the timing feels right, and they put far too much of their portfolio into it. Here is the reality. Even the best investment idea in the world, held in a position so large that a 30% decline keeps you up at night, is a bad position for you. Because the size alone guarantees that your emotional response will override your rational analysis. The right position size is not just about the quality of the investment. It is about the size that allows you to think clearly when things get uncomfortable. The third mistake is the narrative trap, falling in love with a story rather than the actual financial reality. Before a panic, narrative-driven stocks always look fine. But when panic hits, the market stops paying for stories and starts demanding reality. It asks one cold, simple question. Does this business generate enough real cash to survive without depending on constant outside funding? If the answer is no, the narrative evaporates fast. And the fourth mistake is waiting for clarity before acting. Identifying the right framework, understanding the opportunity, and then waiting for one more data point, one more confirmation, one more reason to feel certain. But waiting for clarity in investing means waiting until the opportunity is already priced in. The window does not stay open. And investors who wait for perfect certainty are, by definition, always late. Research, framework, appropriate sizing, and the willingness to act without perfect certainty. That combination is what separates those who capture opportunity from those who only ever watch it pass. Everything we have covered exists within a larger context, the mindset of long-term wealth building. And here is a truth the financial industry rarely tells you directly. The strategies that actually build wealth over time are boring, deeply, profoundly boring. And most people never experience them because boring does not feel exciting, and boring requires patience that our culture has made very hard to sustain. But boring works. The first principle is that time in the market is almost incomparably better than timing the market. Compounding is growth on growth. The early years of an investment, the years that feel like nothing is happening, are actually doing the most important structural work of the entire process. When you sell during panic and sit in cash for months waiting for the all-clear signal, you are not just losing the recovery. You are losing the compounding on that recovery for every single year that follows. That cost is not visible the day you sell. It is visible 20 years later. The second principle is the separation of price and value. Price is what the market says something is worth today. Value is what the underlying business is actually worth, based on its cash flows and long-term earning power. When panic hits, price falls away from value. The panicking investor looks at a falling price and sees danger. The prepared investor looks at the same price and sees a discount. The same strong business, now available cheaper because other people are temporarily irrational. That reframing from danger to discount is not natural. It requires deliberate mental training. But once it becomes your instinct, market panic stops being a threat and starts being an opportunity. The third principle is doing less. There is enormous pressure to always be doing something, always researching, always trading, always reacting. But for long-term investors in quality businesses, most of this activity is not just unnecessary, it is harmful. Every unnecessary reaction to short-term noise is a withdrawal from your rational decision-making energy. The investors who build the most substantial wealth are often the ones with the lowest portfolio turnover. They buy carefully, size appropriately, understand what they own, and then have the discipline to leave it alone while the business does the work. Discipline does not look like constant activity. It looks like patient inaction in the face of constant noise, interrupted only by decisive, well-reasoned action when genuine opportunity presents itself. That is the mindset. And in the final part, I am bringing everything together with a clear warning and the one question you must answer before this video ends. Welcome to the final part. You have stayed through 4 parts of this video. That alone tells me you are serious. And because you are serious, I am going to speak to you seriously in this last section. No softening, no comfortable conclusions, just the truth as clearly as I can deliver it. Here is the warning. The opportunity that exists right now, the window of thoughtful positioning before broader market stress becomes the dominant narrative, is a limited one. Not because I have a precise prediction about timing. I do not. And anyone who tells you they do is not being honest with you. It is limited because of the nature of how markets work. When the panic becomes obvious to everyone, when it is the lead story on every financial channel and the primary conversation in every investor group, the easy positioning opportunity will already be gone. The stocks that offer the best combination of quality and reasonable valuation will already have been recognized by institutional investors who move faster and with more capital than most individual investors can match. The window that exists before that moment is exactly where we are right now. Quiet. Not dramatic, not obvious, just a set of signals, for those paying careful attention, that suggest the risk environment is shifting and that thoughtful investors should be thinking carefully about what they own, why they own it, and whether their current positioning reflects clear thinking or the accumulated drift of months of comfortable markets. This is not a call to panic. This is a call to clarity. Now I want to address something directly, because I know it is in the back of some of your minds. You might be thinking, Zara, what if the panic does not come? What if I reposition thoughtfully toward quality businesses with strong cash flow and durable competitive advantages, and the market just keeps going up? What then? And my answer is this. If you shift toward higher quality, more defensible businesses with appropriate position sizes and clear understanding of what you own, and the market goes up, you will participate in that upside. You will not participate in the maximum possible upside that you might capture if you held only the most speculative, highest beta positions, but you will participate. And you will do so with a portfolio that you can hold with genuine conviction, that you can understand clearly, and that you will not abandon at the worst possible moment when the environment inevitably changes. The cost of quality in a rising market is slightly lower returns than the most aggressive possible approach. The benefit of quality in a falling market is survival, confidence, and the ability to make rational decisions when irrational markets create the best buying opportunities of the decade. That trade-off is one that every serious long-term investor should be willing to make deliberately and consciously. Now, here is the single most important question I want to leave you with. If the market dropped 30% from today's levels, what would you do? Not what do you think you should do, not what you would tell someone else to do. What would you actually do based on your current portfolio, your current financial situation, your current emotional relationship with your investments? If your honest answer is that you would panic, that you would feel an overwhelming urge to sell, that you would lose sleep, that you would make decisions from fear rather than from analysis, then that answer is not a personal failing. It is information. It is telling you something important about the gap between your current positioning and your actual risk tolerance. And it is giving you the most valuable thing you can have before a period of market stress, which is clarity about what needs to change. Use that clarity now, while you have the space to think clearly. Adjust your position sizes to levels where a significant decline does not break your ability to think rationally. Move toward the categories of businesses we discussed, the ones with real cash generation, recession-resistant demand, and durable competitive advantages. Build your understanding of what you own so deeply that a falling price does not shake your conviction, because you know the business has not changed, even if the stock price has. And perhaps most importantly, write down your plan, not in your head, on paper. What you own, why you own it, what would have to change fundamentally for you to reconsider, what price decline you would tolerate before reassessing. That written plan is your anchor in the storm. It is the rational voice of your current, clear-headed self speaking to your future self who will be under enormous emotional pressure when the panic is loudest. The investors who look back at this period 5 years from now with gratitude and a portfolio that reflects real wealth built through real discipline will not be the ones who had the best predictions. They will be the ones who did the preparation, who asked the hard questions, who made the uncomfortable adjustments, who chose the boring, durable, patient path when everything around them was pulling toward excitement and reactivity. That choice is available to you right now. Not tomorrow, not after the next earnings report, not after the situation becomes clearer. Right now, today, with the information and the framework you have been given in this video, you can begin thinking and acting like an investor who builds lasting wealth, rather than one who chases returns and catches panic instead. This is the last chance the title speaks of. Not the last chance to buy 4 specific stocks, the last chance to prepare thoughtfully before the environment makes thoughtful preparation much harder. That window exists right now. What you do with it is entirely up to you. My name is Zara. I hope this conversation has given you something real to work with. Not hype, not promises, just honest, grounded thinking about how serious investors approach serious markets. Take care of your capital. It took real effort to build it. Protect it with the same seriousness.